What's going on? What's going on, SMT family? This module for the day trading model is going to be called the central bank dealers range, and how we could use the central bank dealers range to anticipate us in determining the high and low of the day. The central bank dealers range is from 4 p.m. Eastern to 8 p.m. Eastern, and we highlight the bodies of the candles in the range and draw a box around this range. We use a vertical line to delineate the time of the range, which is from 4 p.m. Eastern to 8 p.m. Eastern. Now, the central bank dealers range works on deviations, right? The measurement of the price range and pips can be replicated in terms of deviations. So that could be anywhere from 1 to 4 standard deviations. One standard deviation above and below would be the same range added to the high of the central bank dealers range, and one standard deviation is the same range that makes up this total central bank dealers range in terms of pips. So the entire range itself, we want to see it as a standard deviation curve, right? If you have guys taken math class, right? You have a central point, and then to the right of the chart, there's 61.8, 38.2, all those deviations, right? If you ever taken geometry class. And to the left, it's negative, those are 1 standard deviation, 2 standard deviation, 3 standard deviation, right? Now, in terms of when it comes to the chart, and this is how I see it, the standard deviations are going to be above and below the day. This right here would be your range, right? This will be the central bank dealers range. I'm going to use that as CBDR, central bank dealers range. This would be the central bank dealers range, right? This would be 4 p.m. and this would be here 8 p.m. right? Now, typically this is what's going to happen on most sell days where we're bearish in the market. The high of the day will be posted up to 1 to 3 standard deviations to the upside, right? So perhaps this is our range, right? Our high of that day would go 1 to 3 deviations to the upside. Now, stay with me, for example. The range will never be this big, right? It will be about something like this, even smaller, right? So I'll just mirror that real quick. Just like that. And say we're getting a sell day, for example, right? Let's just use for this example, it's only going to move 2 standard deviations, right? Price will manipulate the upside for up until London session, right? And the central bank dealers range has to be less than 40 pips. So from 4 p.m. to 8 p.m., the range itself has to be less than 40 pips, right? So we have a couple rules, right? The time is from 4 p.m. to 8 p.m. Eastern. We use the bodies of the candles in this range and draw a box around that range. We use a vertical line to delineate the time of the range, 4 p.m. to 8 p.m. Eastern. And we use a ruler, or we just can manually count the amount of pips, which is less than 40 pips. So ideally, our bearish days shouldn't see more than 3 deviations, typically. On a large volatile day, you have 4 deviations to the upside of manipulation, where the high of the day would be posted. And this high of the day typically is around London, right? So say this is London open. This would be your 2:30 to 3:30 a.m. Eastern price. And this is essentially where you would be selling short, right? Then your take profit is going to be the low of the range, the low of the central bank dealers range right here. And there's going to be a built up of orders there where they bought into, right? Because they're manipulating price. The banks are manipulating price to reach that deviation for them to hit a premium price for them then to sell short. So this would be your draw on liquidity, right? Your central bank dealers range would be your draw on liquidity. Now what's going to happen is below here is going to rest a pool of stop losses, because the people who are buying that breakout trade, not knowing that the high is being posted at 3 a.m. and they're just chasing that trend, their stop loss is 30, 40 pips below that low. So the bank is going to come and hit their stop losses below the central bank dealers range, because that's where they built up the orders. And this is called open flow. The existing stop losses in the current market. Right, so imagine this being the range, right? This box right here. Say these are the orders. 8 p.m. hits, and then they build up the orders, build up the orders, build up the orders. Boom, they hit 3 a.m. They do a large spike and then drastically come down. They hit again, they'll hit the order block, come down, break down, break down. This is about 5 a.m. to 7 a.m. They'll retrace, right? They'll retrace that. I don't know where my brush just went. Sorry. Let's just say they retrace that, right? Typically, you would draw your fib down from here to here. Once that hits the 62 to 79, boom. That'll be your optimal trade entry for New York to go short. And then they'll drag it down just like that. Sorry. And they drag it down below the equal lows, aka the drawn liquidity from the central bank dealers range. And that'll be the day. A lot of times you see this market profile happen in the market. And this would be for a bearish day. Right? So the central bank dealers range is from 4 p.m. to 8 p.m. Eastern. You're looking for price to go about 1 to 3, 4 at most deviations to the upside. And then you want to line that up with the London kill zone, about 2:30 to 3:30 a.m. Eastern. You'll see a breakdown, and then 5 to 7 a.m. they'll do a retracement, and then they'll form the optimal trade entry to go short for New York. There'll be some present of an imbalance here, and that's where you want to look at your orders. So notice from right here to here, there's probably an imbalance in price, something like this. And that's where you want to be looking and stopping your shorts. Right, so you don't want this range to exceed this right here, this range from 4 p.m. to 8 p.m. You don't want that to exceed 40 pips. And you don't want it to be in the trending type of situation where it's dropping down aggressively, right? That's not a algorithmic principle that we would use. And a lot of times what you could see is just one deviation being drawn, meaning that if we're selling, they only use one deviation, and then our high gets posted right here for selling days and for bullish days as well. If we're in a bullish day, our low will be posted right underneath, just like that. And how you get your boxes is that you just clone the range. So you know you have an exact range and you clone it. and we just put it right underneath, right? Now, what's super important about this is that we're giving you literally the keys on how to unlock the high and low of the day. That's the biggest takeaway. And we're doing that by using this dealer's range, right? So if I draw this out in a box, right? Let me just delete this so I can show you. So say this is your range, right? This is your central bank dealer's range. And now let's just clone this real quick. Let's just use 3 for the example. So make a different color. Okay. That's 1, that's 2, that's 3, that's 1, that's 2, that's 3. That's not a 3. That's the 3, right? So your buy setups will be underneath the range, right? Because they're manipulating down, trying to purchase at a lower price, right? So say this is your range, right? You'll see something like this, right? And then, right? And they'll establish a low, and then, well, right? That's what you would see for a buy model day. And I already showed you what a sell model day would look, right? So you want to be buying underneath that range for buy setups. You want to be selling. This is going to be your sell setups above the range, right? From here to here. This is your sell setups. A little typo there. And your buy setups are from here to here, right? So we have the range. Buy setups are underneath. Sell setups are on the top. Now, what makes this high proximity setups as well, high probability, is that perhaps we have, let's go put this over here. Perhaps we have a setup of equal lows that have been built up like this. And we're in the range and we built up like that. And you don't know exactly what's going to happen, right? Your directional bias is a little off. You don't know, where's the direction going to go. DXY is, there's imbalance above and below, right? You see these equal lows, and then from 8 p.m. to about 2 a.m., they trade below those lows. That gives you excellent probability that's going to be a buy day. And then vice versa for the sell day. If you see a buildup of equal highs above, they're going to chase that, and then they're going to sell short. So now that we have the rules, let's now go into some chart examples. And let me just leave this here. Now also, this time here can also be delayed by economic calendar events or just pure liquidity, right? So it's not always going to be exact at 3:30 a.m. Not always going to be 2:30. It could be 4 a.m. It could be 7 a.m., 6 a.m., right? But typically this is for a London setup. All right. So let's go into the chart. Let's go into GBP USD. So let's do Euro first. Because I already had that setup already marked out from this past week. So let's just scratch this chart real quick. And this is the past week. Now, what do we say? Well, rule number one, we do 4 p.m., which is 1500, to 8 p.m., which is 2000, just like that. And we draw our box around the candles' bodies. Just like that. Now that's the central bank dealer's range right there. Now, on this day, we're bullish because the dollar has been bearish, right? On this exact day, the dollar was bearish, so we're bullish on this, right? So we want to see a trade underneath these lows, right? You want to see the trade go underneath these set of lows, right? So I'll do my deviation, I'll clone it, 1 or 2, right? For this day, it went only 1 deviation below. So this is 1 deviation, this is 2 deviations, right? Notice how price hits the low right here. That's 1 deviation. 1 standard deviation. And what time is this? 6 a.m. So what did they do in this scenario? So let me make this a different color. Boom. So that's the central bank dealer's range right here. Right here, central bank dealer's range. From here, we're bullish. So what do you want to see? You want to see them trade down, right? Remember the diagram I showed? You want to see them trade down. And they did that right there. This right here is the low of the day on the 9th of April at 6 a.m. They hit 1 standard deviation below the central bank dealer's range. Now, there's one thing I left out. They always will fill 4 numbers for the day once they hit the low or high. So once they have their high or low set, depending on the direction. So if they're bullish, this will be pegging the low. If they're bearish, right, they'll peg the high. Now, once they fill this, they have to go 4 levels, aka 4 deviations minimum above the central bank dealer's range. And that's your take profit level. So watch this. This is 1 above. This is 2 above. 3 above. And 4. This is not as precise. Right there. And 4. And you're getting out of the market right here. So you go from 1084 to 1091. 1084, 70 pip trade. This is a 1-to-7 ratio. You put your stop loss right underneath. This will work about 10, 20 pips below. We always risk 20, 30 pips. And this is a 1-to-7 ratio. Right, so this is how you would be using central bank dealer's range for this day. Very clean. Central bank dealer's range 1500 to 1800. I mean 2000. 1500 to 2000. Right? It's 4 to 8 p.m. Then what do? They manipulate down, clear the equal lows here. 1 standard deviation below, they set the low of the day. Right, low of the day. Right there, on that wick to the T. And then they go up, 10 a.m., come back down, wick above, restack the orders again, and they go bullish. Right, so off of this trade, you would have made about 50 pips right there. It comes back down, retest, and then blast through for New York, right? So that's that example for for EU, right? And that's how this went, right? Central bank yields range, they went one below, they set the low here, and then they went bullish, right? So let's do this for GBPUSD. This is a nice range right here. It's not a trending range. Let's clean that up. So let's look at this day. So we draw a vertical line from 4 p.m. to 2000, right there. That's our dealer's range. We use just the bodies. And let's see how many deviations this one goes. Should be about 1.5, maybe 2, the way it looks. Right. So we go about 1.5 or so. So that's the central bank dealer's range. Those are the 2 deviations that it goes below. And it sets the low what time? 2 a.m. Right, so that went 1 3/4, well, almost 2, right? Almost 2 deviations. Right, so that's the range. We're bullish on day 2. Why? Because also dollar is going bearish, so we're bullish on GBP USD. And right there, smacks the low of the day at 2 a.m. We'll be buying here with stop losses underneath. And we go 4 deviations to the upside for a take profit level. Now, remember, we don't have to use that 4 deviation, but it's a good direction and guide when it comes to not knowing when to get out the market for those who need discipline and things of that sort. So let me just make all these colors blue. So you guys can see, okay, so the pink is the dealer's range, and the blue right here below, this is the low of the day, right? Approximately 2 deviations to the low. And look how price never comes back there. And also, when you're here at that level, you gotta look where we are in price, right? Look where we are. At that low of the day, we're coming for these equal highs. So we don't have to use the 4 deviations. We could just trail our stop loss because we're coming for the equal highs here because dollar is bearish. So what they're gonna do, they're gonna trade above here and then go short and trade some of the move, right? And that's what we get here. Central bank dealer's range, 2 deviations below. So this is our buy setup. They hit back down on this fair value gap right here. Notice the fair value gap. Right there. That's a fair value gap trade right there. So we can use CBDR with fair value gap with directional bias, and that gives us a clean trade setup. Right here, you'll be buying down here 3 a.m., 2 a.m., 3 a.m., 4 a.m. right there. That would be your ideal buying scenario, and then going bullish for 40, 50 pips, right? 100 pips. I don't want to get off tangent, but this right here, this right here, turtle soup long, right? Nails equal lows, then goes bullish, equal highs right here, get targeted, clears out, then retrace down to fair value, central bank deals range, 2 deviations below, 4 deviations above. Literally right at the fourth one, it gives you a retracement. Literally right at the fourth, it offers you a retracement, right? And this is a 1 to 6 risk to reward, right? Right, 1 to 6 risk to reward, right? So that's the central bank dealer range, guys. Some rules. So central bank dealers range must be 15 pips and above in a clear range, not trending from 4 to 8 p.m. Eastern, and no bigger than 40 pips. Your Asian range ideal is 20 pips and more. And then just keep in mind how we use the bodies for the central bank dealers and not the wicks. Okay. I hope this helped you guys. We merged together examples with the actual module itself. And let's look for one more example. If we don't get another example, it's okay. Let's try GBP CAD this last week. Let's see where it's a definite range. Definite range. If not, let's use the dollar pairs because those look like the exact movement that we wanted. Okay, yeah, this one right here. So 1500, 2020, that's not more than 40. Right, because I take my ruler and I go from here to here. It's 34, so we're good. Use the bodies that's covering. That's the central bank dealers range there. It looks like they go 1 deviation below. But let me just show you guys. Right, so that's 1500 to 2000. So the box got to be just a little bit squeezed. Right, so about 1 deviation. Right here, they come a little bit below, but that's 1. If you want, that's 1 for me because of where the candle closed. The candle closed 1 below, right? So right there. There's 6 a.m., 4 a.m. right here. Stop loss 20 pips below. This is the central bank dealers range right here. Has 1 below. They set the low of the day right here. Notice how they didn't break this line. They only wicked above it. And then we go 4 above because that's our take profit level, right? 1, 2, 3, 4. Just change this right there. And notice how we decided to consolidate right after. So this was a 1 to, this is a 200 pip trade. A 200 pip trade right here. Right? Let's mark this so everybody knows. $1,500, $2,000, that's 4 to 8 p.m. Eastern. 1 deviation below, 4 deviations to the upside because we know that it fills 4 numbers. That's 4 above the range. We could have used each one of these as take profit levels. Like him in first take profit, second take profit, third take profit, fourth take profit. And that's how they do it. And then one gem I'm going to leave aside here is that they use these deviations as true support and resistance in the new days that form. And that's where you could find setups in continuation. And that's one gem I'm going to leave in here for everybody to figure out. Right. So thank you guys. I hope you guys enjoyed this central bank dealers range model with 3 examples of exactly how to use it. And I will see you guys soon, and take care. And do not try to give this to any random person. Okay. Let's keep this within the house, and take care. Enjoy the sauce.